Credit cards are everywhere, and they're incredibly convenient. But here's the thing that most people don't understand. They can also be one of the biggest financial traps you'll ever encounter. The interest rates are brutal, and if you're not careful, you can end up paying way more than you actually spent. So today, we're breaking down exactly how credit card traps work and how you can avoid falling into them. If you're serious about building wealth, make sure you subscribe to this channel because we cover financial strategies that actually work. Let's start with the basics. A credit card is essentially borrowed money from a bank. When you swipe that card, you're not spending your own cash. You're spending the bank's money, and they're expecting you to pay it back. This is where people get confused. They see the credit limit and think it's free money they can use whenever they want. It's not. Every single dollar you charge to that card becomes a debt that you owe. Now, here's the critical part that most people miss: the due date. Your credit card statement arrives every month with a due date clearly printed on it. This date is incredibly important because it's your window to pay back what you borrowed without paying interest. If you pay the full balance before this due date, you pay nothing extra, zero interest. You essentially got a free loan for 30 days. But if you don't pay the full balance by the due date, something terrible happens. The bank starts charging you interest on whatever balance remains. And credit card interest rates are no joke. They typically range from 15 to 25% annually, but sometimes they're even higher. That's an enormous amount of money you're throwing away just for the privilege of carrying a balance. Let me give you a concrete example. Imagine you charge $1,000 to your credit card. The due date arrives, but instead of paying the full $1,000, you only pay $200. That means $800 remains on your card. The bank will now charge you interest on that $800 every single month until you pay it off. At an 18% annual rate, you're looking at approximately $12 in interest charges that very first month alone. It doesn't sound like much, but it adds up incredibly fast. The trap gets even worse when you understand how credit card companies make their money. They're betting on you not paying the full balance. They're betting on you carrying a balance month after month, year after year, slowly drowning in interest payments. This is their business model. They make far more money from interest charges than they do from the transaction fees merchants pay. So how do you avoid this trap? The answer is surprisingly simple, but it requires discipline. You must pay your credit card balance in full before the due date, every single month, not most months. Every single month. This is non-negotiable if you want to use credit cards without getting trapped. Here's the strategy that actually works. You use the bank's money by making purchases on your credit card. You buy groceries, gas, clothes, whatever you need. But here's the key. You only charge things you already have the cash to pay for. If you don't have the money in your bank account right now, you don't charge it to the credit card. This is the fundamental rule. Then, when your statement arrives and you see the due date, you pay off the entire balance before that date passes. You pay it off completely. This way, you use the bank's money for free, essentially getting an interest-free loan for about 30 days. Zero interest. Zero extra charges. You're borrowing money and paying nothing for the privilege. But here's something even more powerful that most people don't realize. After you pay off your balance, you can recycle that credit available to you and use it again. Your credit limit resets, and you can immediately start using that card again for the next month's purchases. It's like getting a free renewable loan every single 30 days. This is how you turn a credit card into a tool that works for you instead of against you. You're not trying to build up a balance that earns you interest payments. You're using the card strategically to make purchases, then immediately paying it off. Some people even use this to their advantage by earning rewards points on every purchase. While you're paying the full balance and avoiding interest, you're also collecting points that can be redeemed for cash back or travel rewards. That's free money on top of everything else. The people who get trapped are the ones who view their credit limit as actual money they can spend. They charge things they can't afford and tell themselves they'll pay it back later. But later never comes, or it comes too late, and suddenly they're drowning in interest. This mentality is the biggest mistake you can make. Let me break down what happens in a worst-case scenario. You charge $5,000 to your credit card. You tell yourself you'll pay it back soon, but soon doesn't happen. A month goes by and you only make a minimum payment of $150. Now you owe $4,850, and interest starts accruing. The next month, you pay another minimum payment, and the interest adds on top. Before you know it, you've paid $1,000 in interest alone on that original $5,000 charge. You've essentially paid 20% extra just for the privilege of not having cash. This is where credit card debt becomes so dangerous. It grows exponentially when you're only making minimum payments. The interest compounds, and you end up paying far more than you originally charged. Some people spend decades trying to pay off credit card debt, accumulated in just a few years. The other trap people fall into is having multiple credit cards and spreading their debt across all of them. They think they're being smart by dividing up their debt, but what they're actually doing is creating multiple streams of interest payments. Each card has its own due date, its own interest rate, and its own minimum payment. Suddenly, managing your finances becomes incredibly complicated, and it's easy to miss a payment or forget a due date. If you're going to use credit cards, keep it simple. 1 or 2 cards maximum. Know the due dates, mark them on your calendar, set phone reminders, do whatever it takes to remember when you need to pay. Missing a due date doesn't just cost you interest, it also damages your credit score, which affects your ability to borrow money in the future at good interest rates. Now let's talk about something important, how to actually implement this strategy in your life. First, you need to have the discipline to only charge things you can pay off. This requires a mindset shift. You need to stop thinking of credit as free money and start thinking of it as a tool. Second, you need to set up a system to ensure you pay on time. This could be automatic payments, calendar reminders, or simply paying your balance the day you receive your statement. Third, you need to resist the temptation to carry a balance intentionally. Some people think they're building credit by carrying a small balance. This is false. You build credit by making purchases and paying them off in full. The credit bureaus don't reward you for paying interest. They reward you for demonstrating that you can handle credit responsibly. Here's another powerful insight. If you pay your credit card in full every month, you never have to worry about interest rates. It doesn't matter if your card has a 12% rate or a 25% rate. If you're not carrying a balance, the rate is irrelevant. This is why the best credit card deals aren't always about the lowest interest rate. They're about rewards, benefits, and protections that help you as the consumer. Let me circle back to the recycling concept because it's genuinely powerful. Every month, your credit becomes available again. If you have a $5,000 credit limit and you use the full $5,000, then pay it off. That $5,000 resets and you can use it again next month. You're essentially getting a free renewable line of credit that resets monthly. That's a powerful tool when used correctly. The bottom line is this: credit cards are not evil. Banks are not evil. But they're designed with incentive structures that benefit them when you carry balances and pay interest. Your job is to understand this and refuse to play their game. Use the bank's money for free by paying before the due date. Recycle your credit limit month after month. Avoid the interest trap entirely. This is how you build wealth instead of watching it disappear to interest payments. If this perspective on credit cards has been helpful, please like this video and subscribe to the channel for more financial strategies that work.